Hello, everyone, and welcome to another Kepler Insight webinar, where today we're going to be focusing on all things US LNG, with a particular focus on project statuses and also their commercialization. My name is Laura Page, and I head up the LNG and natural gas research team at Kepler, and I'm based in London. And today I'm joined by my colleague JP Lacouture, who is based in New York, and he heads up all of our natural gas analysis out of the Americas. So the plan for today is essentially to take a look at where we are in terms of US LNG production and capacity, looking at where it stands today, but also looking at all of the projects that are under construction at the moment, because there's quite a few of them that are due to come online through the rest of this decade. I'll then be passing over to JP, who's going to run you through some really interesting analysis that he's done on contracting and financing trends, and also on regulation and permitting. We're going to finish off as well by just thinking about the market, thinking about all of this LNG supply coming to the market and whether there's enough demand to soak that up, as well as looking at the potential for US shut-ins as well as we go through the rest of this decade. Of course, we will finish off with Q&A as we always do with all of our webinars. So if you do have any questions on this subject or you want anything clarifying, please do let us know in the Q&A box, and we'll be sure to get to as many questions as we can towards the end of this presentation. So first, let's look at US LNG export capacity and production, because it's been nearly a decade that the US LNG has had supplies on the water. Of course, it all started off back in early 2016 when Cheniere brought online the first of now 6 trains at Sabine Pass. And steadily over the past decade, we've seen LNG supply building up in the market from the US. It's been making up a larger share of global supplies, and that's really changed the dynamics that we've seen in the LNG market, because of course US LNG is destination flexible. It largely goes to the highest price market, so that can be Europe, that can be Asia or South America, depending on supply and demand, and also pricing dynamics in the market. Now, today, the US is the largest supplier in the market. We saw the US overtake Qatar and Australia in 2023 as more capacity came online. And currently, we have 8 liquefaction projects coming online. By the end of this year, we should have about 121 million tonnes per year of supply. Of course, the US is going to increase their supplies of LNG this year. One of the things that we do in the Kepler Insight team is we forecast supply on a project basis. And we think that the US is going to export about 108 million tonnes of supply this year, accounting for a phenomenal quarter of all LNG supplies. Now, a lot of the growth that has come this year has really been from the Plaquemines project. This is a Venture Global project that we've had lots of questions on actually this year, because they've been bringing online a lot of their trains and blocks very quickly, but also many of these blocks have been operating above nameplate capacity. So a lot of supply growth has come to the market in 2025. And it's not the end of this supply growth, really. In fact, we do think that capacity could nearly double from now until about 2030. And currently, we have about 113 million tonnes per year of capacity that is under construction, coming online from 2026 onwards. One of the projects that we're focusing on, as well as Plaquemines at the moment, is Corpus Christi Stage 3. We think 4 trains could come online this year, followed by a further 3 trains next year. So we're following that one closely, but we're also following very closely Golden Pass. Of course, we've seen first feed gas deliveries into Golden Pass, and the project could be getting a cool down cargo very soon. to speed up the ramp up and the commissioning of that project. So certainly something to watch in 2026, going into 2027, all of those three trains coming online. We're also following quite closely Port Arthur Phase 1 and Rio Grande Phase 2, the first three trains of Rio Grande, which could both come online in 2027. And we could see CP2, also another Venture Global plant, coming online at the end of 2027. Of course, more trains to come online at other plants as we go through the course of the decade. So lots that we need to be focused on and watching out for. And of course, Kepler Insight are tracking these projects quite closely so we can help you to keep track of everything that's going on outside of the US. So I'm going to pass over to JP, who is going to start off by looking at the contracting trends that we've seen in the US LNG market.
Great. Thanks, Laura. So, yeah, so overall, we're going to kind of look at what's been going on with U.S. projects in terms of just overall commercialization. And, the sort of three big pillars of that are finding buyers, getting approval from the government to build a facility at all and export the commodity. And then, of course, finding the money to build the project in the first place. So those are sort of the three big pillars. So we're going to touch on sort of what's been going on with contracting first. So why don't we go to the next slide? So just a little bit of history. Historically, most of the world's LNG has been sold on an oil-linked basis. Most of the traditional buyers of LNG very used to dealing with the oil market, so it just made a lot of logical sense to tie LNG to that, even if it's not maybe the most appropriate thing to do, just considering how different they are as commodities. But that has been the case. So it's usually like a slope, percentage times whatever oil price they choose. Back in the day, it was the JCC over in Japan that's been expanded to more Brent is usually what people use now. Um, and then maybe some constant applied to it or added shipping costs or stuff like that. There's also been like different types of formulae called like S curves that set like a floor and a top end price to accommodate for when oil dips or increases above a certain point. But oil has been the predominant price linkage. There's been some contracts that were MBP and TTF linked, but for the most part, it's been a liquids linked market. When the US came online, very exciting for a lot of buyers to get some LNG that was not oil linked to diversify away from that, as US LNG is almost entirely sold on a Henry Hub link basis, which is pretty decoupled from global gas prices and global oil prices for the most part. There's some sensitivity in there, but the US has a very evolved, complex market that's kind of a thing in its own. So very exciting for a lot of buyers to be able to de-risk some of their LNG portfolios by shifting over to a gas-linked LNG offtake contract. Um, for the projects themselves, they typically needed about 80% of the nameplate capacity of the project sold via long-term contracts before they were able to secure financing. In terms of cost of these projects, it's multiple billions of dollars. Most of the larger ones are tens of billions of dollars. So most companies cannot afford to, fully, finance these things themselves. And why would they when they can take debt? So most of the time, these projects were financed with a combination of some equity, either from the project company themselves or from a third party, and then financing from other financial institutions. And we'll touch on that a little bit later. But you typically needed about 80% or more of your capacity sold before it was de-risked enough to find the money that you needed. Um, there's also been, there's been a profound shift in who is buying LNG these days, especially out of the US. And that's mainly what we're going to look at in this section is who is buying the existing LNG and who is buying the LNG that's under construction or pre-FID. In order to kind of look at that, we kind of split the buyers into sort of three different groups. And it's, there's a lot of nuance, obviously, in what buyers are doing these days, but this is kind of how we conceptualized it to do this analysis. So first of all, there's the end users. So typically companies that buy the LNG specifically to use it themselves or to take it to their home market. So, your PetroChinas and your Tokyo Gases. They're buying LNG for domestic use, basically. Obviously, nuance there. A lot of Chinese buyers, obviously, especially right now, are diverting their U.S. cargoes over to Europe, so they're not actually taking them. But in terms of just like the generic buyer type, we included them there. So that's like your NOCs and your companies like that. And then we have like traders and portfolio players, which are, predominantly their role in the market is they take a lot of LNG, they buy a lot of LNG, and they resell it to other people. There's pure trading houses like your Gunvors, your Glencores, and stuff like that. But then there's companies like Shell and BP who have the largest portfolios, and like Total, where they do some, they send LNG to specific places that they operate, but for the most part, they're operating a big portfolio and they move cargoes around as needed, depending on what prices are looking like. And then there's hybrid players who kind of do a bit of both. So, you have companies like Repsol and JERA, which have like a substantial amount of LNG that they sell into their home countries, but also they engage in some trading. Like JERA and EDF trading are, have their combined trading arms, and they do a lot of trading cross basin. You have like Centrica, who sell some spot, but also import for their own uses in the UK. So we classified them as hybrid players. And like I said, there's a lot of nuance here. You could probably debate endlessly on what category some of these companies fit in, but this is kind of what we set up to kind of provide a little bit of insight into what's been going on the contracting side of things. I just included the Sabine Pass contracts for the original few trains there, just to kind of provide some context. So, it's a pretty decent mix, but a good amount of it sold to trader and portfolio players. Some of that was then specifically sold via secondary contracts to end users, but not a ton of it. So we can go ahead and go to the next slide. So this is the look at the contracts that were sold from the sort of all of the installed projects. So from Elba over is all the sort of quote unquote first wave projects. Train 3 at Corpus Christi by some measures can be considered a second wave. Depending on who you ask, and train 6 at Sabine Pass, same thing. But we're going to call that first wave projects. So the first set of projects that achieved commercialization in the US. And then the things to the right of that are sort of your second wave projects. So for the most part, it's a fairly, I wouldn't say it's not an even split, but it's like a decent split between all the buyer types. So you have portfolio players taking up a lion's share of like Sabine Pass, Cameron, and Freeport. But lots of end users buying cargoes from Corpus, from Plaquemines especially. So there's a decent mix here from of buyer types. So like between your sort of hybrid players who are a little bit like end users and then actual end users themselves, about a little bit more than half of the LNG installed in the US is sold via long-term contract to these players. In case people are curious what the SPL/CCL is, that's just additional cargoes sold from either Sabine Pass or Corpus Christi via long-term contracts. So it can come from either project. Um, but these projects are exciting, especially the first wave projects for buyers because they have that Henry Hub linkage, but they also had a full destination flexibility. So there wasn't anything in the contract saying you had to sell LNG to this specific place. You could send it wherever you want, which that really enhanced the ability for a lot of trading houses and portfolio players to play with those cargoes. Um, but yeah, why don't we go to the next slide? So things have shifted quite a bit for the under construction projects, and there's many reasons for this. But let's talk about the notable changes. So there's a lot more of that teal color here, and that's because traders and portfolio players are taking about 2/3 of the capacity under construction right now. And this is just like versus installed capacity, long-term contracts. Anything produced above nameplates probably going to be sold on like a spot short-term basis as well. Looking at projects like Corpus, looking at projects like Woodside to some extent, maybe even the Port Arthur projects or especially CP2. But there's been a big shift towards trader and portfolio players. Additionally, a lot of these projects have a pretty sizable amount of unsold capacity still. These have all reached FID. They're under construction. The sort of biggest factors here are Woodside, Louisiana, which currently only has two offtake contracts. It's been under construction for a few months. Um, Obviously, it's a legacy project because Driftwood's been around for a long time, but effectively collapsed, and Woodside's kind of outside of the construction work that's already been done at the project site is kind of starting from scratch in some ways. But this is a big departure from the way things used to be. That 80% capacity sold threshold is clearly not fully intact here anymore, especially with Woodside, especially with CP2. So, I mean, like one could look at this, and I think the logical conclusion for some of these projects is that like leftover capacity, a lot of it will be absorbed into the project company portfolios. Port Arthur Phase 1 sold enough that to hit commercialization, but Port Arthur Phase 2, basically the second train has, I don't believe, any off-takers, or if they do, it's split between the two trains. So, who's going to take that? It's a big question. CP2, like Venture Global, has built out a very sophisticated and large trading arm over the years as they sold their commissioning cargoes. And, it's possible that that remaining capacity at CP2 might be absorbed into that, especially once, Plaquemines enters commercial service and most of those cargoes are then sold to the actual contractors. Though there's a sizable amount of capacity tacked onto the top of Plaquemines that will probably be available for VG as well. That's like excess of nameplate. So a lot of interesting stuff happening here. And, one could ask, why are portfolio players so involved in these projects? Um, Good question. I think there's a certain amount of some of these end users don't really see themselves needing the LNG potentially in the long term. Chinese buyers, European buyers, stuff like that. I mean, after 2022, basically all of these projects got a ton of momentum. Like a lot of, projects like Port Arthur, like Rio Grande, and several others that are pre-FID but advanced, they've been around for quite a while. And the pre-2020 market, there wasn't a lot of room for new supply. You had big projects like Qatar and Mozambique coming in and taking up a large amount of the sort of incremental demand growth in the markets. So there wasn't, there are a lot of questions like, had we reached basically peak US LNG, but then Russia invaded Ukraine, pipeline gas was cut off, and all of a sudden the EU went from kind of being a flat demand market going forward to being one of the bigger demand growth markets, at least for a few years. So that basically breathed new life into a lot of these projects that were really struggling to find sort of a way forward prior to that happening. Then portfolio players, are in a good position to sort of take advantage of that, as they, are the ones kind of injecting liquidity and into the market, and benefiting from big spikes in prices and stuff like that. So yeah, interesting stuff going on there. But portfolio players very big now in the U.S., or even bigger than they were before, rather. So you can go to the next slide. So with pre-FID projects, the ones we selected here are the ones that are particularly advanced in their contracting. Interestingly, far less unsold volumes associated with these projects. I mean, like some projects, that's not surprising, like Cameron Train 4, which is just all those cargoes are sold to the equity partners. But there's some interesting stuff happening here. I mean, and specifically Lake Charles and Saguaro, both are selling a decent amount of their capacity to Chinese buyers, which certainly is a risk at this point, considering U.S. tariff policy. Obviously, when these projects potentially could come online later in the 2020s, that can change. But the uncertainty certainly isn't helping move things forward there. But a lot of these projects are commercially in a pretty good place. They're well above that 80% threshold. I've got like very good buyers on the leash that have signed HOAs or SPAs with them. So, why are some of these projects having issues with commercialization? Um, it's a good question. I think part of it is there's a lot of fear that there's already too much supply under construction. Um, there's, probably some other, regulatory problems with some of these projects. There's, maybe they're just having a hard time finding financing for a variety of reasons. But there's that sort of inherent risk down the road of like, is there too much supply with the amount of demand that exists? I think is a specter kind of hanging over a lot of these projects. Cameron Train 4, I think, is an interesting one specifically because that project will be sanctioned if the off-takers want it to be. Um, so Total, Mitsui, and Mitsubishi are the off-takers, and I guess at this moment, that's the project doesn't isn't what they're looking for. I mean, that project's been around for a long time. I think it's had some more momentum recently, but we'll see what happens there. But it's a much more interesting sort of way of looking at a project versus ones that have had to actually, they've really had to go out and find new buyers and things like that. Um, Once again, I wanted to mention that I have Saguaro in here, despite it being in Mexico. I also had Ica in the last slide. We included those because they require DOE permits and they're using US gas. So we're just, even though they don't need like FERC approvals or anything, and they're located in Mexico, they're still using US resource to export. So we included them here. But yeah, we can go to the next slide. So this is kind of just the overall view of everything. So all this put together. So you can really clearly see how much of the supply, both under construction and pre-FID, portfolio players have purchased. So that's a lot of that is LNG without a dedicated home. So floating around in the market, being sold on a spot short-term basis, plenty of it is can being committed to long-term contracts that like these portfolio players have, but a good amount of it is not. So something to keep in mind. So, two-thirds of under construction pre-FID LNG in the US is committed to these types of buyers. Hybrid players have really come off quite a bit. A lot of those are like European buyers. A little bit of extra of those end users, but that's mainly the Chinese buyers in Lake Charles and Saguaro. Um, Another noticeable thing is simply how big that unsold amount is in the under construction projects. It's about 30% of that capacity is not committed to any buyers at all. Like I said, that could just be absorbed into portfolios. I mean, Woodside's been in the LNG industry for a very long time, has their own portfolio, albeit this would substantially increase the size of it if they were to take like even half of the Woodside LNG volumes. But we'll see what happens. It's definitely against the orthodoxy that we've seen in the last like 50 years for building an LNG project to kind of build it on spec to some degree. I mean, obviously there's negotiations happening outside the public eye for selling the volumes, but typically that happens before FID. So definitely something interesting going on there. An interesting trend that is not limited to just that project. And then just to touch on like a couple other sort of things we're seeing in contracting, we're also going to look at the duration of contracts. So go to the next slide. So typically in the past, like 20, even 40-year contracts have been the standard. 20 years more common than any other sort of time frame, and sort of required for, at least in the past, required for banks to feel like they were going to get a return from the project and get their loan paid. So very common for 20-year contracts to be the standard. In general, for the US, that's remained the case, especially with that first tranche of projects, even the second tranche of projects, in almost entirely 20-year contracts, with a couple exceptions here or there, but nothing too crazy. We have seen a little bit of a shift towards slightly shorter contracts among the pre-FID and under construction projects. So you can see there on the right chart, just about that chunk of sort of teal on top of the dark blue. Those are all 15 to 19-year contracts. Most of those are 15-year contracts. And the 15-year contracts that have been signed from US projects are all in that table on the left. A lot of them are to Delphin, but the rest of like pretty much every project under construction has at least one contract that's 15 years. And it's definitely interesting. And there's a couple reasons as to why. So some of this is like you kind of new entrants to the market, like EQT, for example. All three of their contracts with upcoming projects are 15 years. So maybe didn't want to risk the 20-year time frame. Who knows exactly why, but it's interesting that they're doing that. Devon Energy, another US upstream producer, also 15-year contract. Um, Additionally, a lot of these companies are European. And during the sort of post 2022 timeframe when contracting for US projects was increasing rapidly, a lot of these companies didn't really want to sign 20-year contracts. The sort of increasing the use of fossil fuels, even natural gas, in Europe is kind of it goes against their overall energy policy. Obviously, at the time and still now, energy security is the most important thing. So making sure they have enough gas and storage to get through winter, keep the lights on and all that. But a lot of these entities were reluctant to sign the 20-year contract because they didn't want to commit for that long. So the 15-year contract, I guess, was sort of a potentially a happy medium for some of these buyers where they were able to take less cargoes over time, but still help underpin these projects and help with commercialization, getting across the finish line. So interesting kind of stuff going on there with tenors, but for most part, 20-year contracts are still standard, like all of VG's contracts at both CP2 and Plaquemines. Those are 20 years. Cheniere's still selling mostly 20-year contracts, all that kind of stuff. And just before we shift on to the next section, just wanted to touch on a little bit like contract trends we've seen in like on the pricing side of things. That kind of stuff is very hard to get information on. It's mostly not in the public sector, so getting the actual like price formulas for contracts is fairly difficult. In terms of the trends we've seen, there hasn't been a huge shift in the contract structure themselves. The sort of generic 115% times Henry Hub plus liquefaction fee still reigns supreme for US contracts. That liquefaction fee has changed over time. It used to be like 350 back in the first contracts that were being passed. Steadily went down over time, especially when a lot of these projects were trying to get, reach FID sort of in the pre-2022 timeframe with, Calcasieu Pass being the sort of big example there where some of their contracts were in the low twos or even upper $1 on the liquefaction fee, which allowed them to get a lot of buyers. And they basically set the floor for the market. But that's changed now that the market is a little less supply constrained, at least in the short term. And so you have liquefaction fees, from what I understand, closer to sort of the $3 range, maybe a little bit under that. But it's hard to sort of really get the information on those contracts. But so the liquefaction fees have changed a bit. The 115% sort of multiplier on Henry Hub is still quite standard. Occasionally you'll see like a 110, but it's pretty rare, usually for shorter term trades and stuff like that. So it's mainly still the 115%. And then there's been some attempts to move away from the Henry Hub linkage, or at least provide flexibility. Like Driftwood was known for trying to offer alternative pricing to potential buyers, oil linked, all that kind of stuff. But for the most part, it seems like buyers are more interested in US LNG because it is Henry Hub linked and still provides some of that diversification away from oil, even though the US is now the largest producer of LNG in the world. So I think it's still attractive in that way. The occasional contract still comes out, maybe oil linked, maybe JKM linked, maybe even we've seen some coal linked stuff, though that's mainly been for gas supply into the LNG facilities. Same thing with the JKM linkages. So that's actually producers diversifying away from Henry Hub within the United States a little bit. So getting some more diversified risk. But those are basically the contracting trends that we've seen. So the big one really is that shift more towards the portfolio player being the dominant off-taker for US LNG over the next few years. So we can go to the next slide. So now we're going to talk about financing briefly. So you can go ahead and go into it here. So talking historically, really the older, like very old LNG projects were mostly financed via like almost entirely equity. But the first project financing that was ever done was actually the Northwest Shelf project in Australia, 1980. So quite a while ago. So project financing has been around for a long time. And, the sort of general split between equity and debt, it ranges quite a bit, but the average is around 70% debt, 30% equity for a lot of projects. And, who are the people that actually provide the debt for these projects? So historically, it's mainly been your commercial banks and especially export credit agencies. when you had that like point to point trade with like Japan and Korea, because this was like an energy security, kind of thing, it made a lot of sense for the export credit agencies to be the ones either lending directly or leading a like consortium of other lenders. Um, so they would typically be the sort of big lenders to these projects. Syndicates of commercial banks are also very common financiers for these projects. You'll occasionally see development banks like the China Development Bank of Japan, the US Development Bank occasionally will put money into projects. Bonds occasionally can be used. And then in more recent times, private equity. And that's mainly what we're going to talk about here is the sort of rise of private equity in LNG, specifically US LNG. Um, just to sort of provide some context on how projects have been financed in the U.S., I included the split of financing for a few U.S. projects, specifically the earlier ones. So you can see Sabine Pass there, pretty much like the with Train 6 and Trains 1 and 2, the that 30-70 split essentially. Though it was backwards for Train 6, with Cheniere taking a lot of equity themselves, based on the proceeds of the first five trains. But um, they kind of did things a little bit differently with trains 3 and 4 and 5. Those are almost purely financed by banks and ECAs. But your Freeports, that Freeport, all three of those trains were financed on essentially a 70-30 split. So equity sold to a third party for the first two, Freeport bought the equity in the last one, and then bank syndicates or ECA-led consortiums are the ones that provided the rest of the funds. Cameron, two of the off-takers are Japanese companies, Mitsui and Mitsubishi. So the Japanese were a big source of money for that project. So JBIC and then the NEII, they gave quite a bit to Cameron. And then equity, there was that project is structured so Sempra owns it, but all three of the off-takers have substantial equity in it. Um, but the sort of big thing to note here is indeed train 1 and 2 is that equity investment by Blackstone. Um, and they basically Blackstone spent $1.5 billion for about a 42% stake in the project company that built Sabine Pass, Cheniere Energy Partners. So Cheniere Energy itself, the parent company, isn't partially owned by Blackstone, but the project company that manages Sabine Pass and crucially not Corpus Christi, it bought a good chunk of equity in it to help fund the first two trains. Um, Previously, private equity wasn't particularly involved in LNG, so this was definitely a pretty new thing in the market. And if we go to the next slide, you can really see how involved private equity has gotten in recent years in US LNG. And they've invested in some other projects worldwide as well, but really a lot of the focus has been in the US, and it's mainly been through equity investments. So big ones here, sort of the really early ones were, of course, the Blackstone purchasing of Sabine Pass. There was also EIG buying about 50% of the Elba Island project. And then you have, sort of more recent investments like Global Infrastructure Partners, who are owned by BlackRock, have a pretty substantial stake in both the Rio Grande LNG project company and also equity in the actual train itself, Train 4 that just hit FID. Blackstone bought a ton of equity, nearly half of phase 2 of Port Arthur. So they've become increasingly important sources of financing for these projects. Not every project is relying on private equity, most notably, again, Venture Global. CP2 is entirely project financed. There's no equity in it at all. They maintain 100% ownership. And for Plaquemines, I believe that was the largest project financing of all time. So they're still doing things a little bit more traditionally in that respect. But then again, PIMCO does own 15% of Venture Global itself. Granted, that's like, not exactly project specific or anything like a lot of these other um, transactions, but definitely something to keep in mind that even though PIMCO doesn't have like direct ownership of any of the trains or projects, they still own a big chunk of Venture Global. Um, but yeah, so lots of private equity and like I think the really interesting ones for me are the transactions where now PE companies are actually majority owners of LNG projects or LNG project companies. Big ones being Kimmeridge, owning 90%, if I believe actually maybe 100% now, of Commonwealth. So they own the whole thing. It's basically a Kimmeridge-led project now, which is definitely very interesting. And then you have also the recent increase in ownership of Sempra Infrastructure Partners from KKR, who previously had a 20% stake and now has a 65% stake. And SIP is the subsidiary of Sempra that owns and operates Port Arthur and Cameron. So they're now the majority owner. They're not the operator, but they do own most of it. So a lot of money going into these projects, which is definitely very interesting, and a good chunk of it being from these private equity firms via equity purchases. That being said, with Venture Global, with Calcasieu Pass, there was a direct investment from Stonepeak of about 1.3 billion. So they didn't fully escape the PE investment onslaught, but yeah, since then they made a lot of money during 2022 and 2023, so they've been able to avoid avoid that for the most part for now. But yeah, so that's basically what's been going on with financing, at least focusing on the sort of private equity side of things. That's like the main trend that we've been looking at. Now we're going to touch on what's been going on with regulatory and permitting trends in the US. So for those of you who are unfamiliar with the regulatory process in the US, I'll kind of quickly go through the sort of big permits that a project needs to move forward. So there's two entities that are responsible for these permitting. There's the Department of Energy and then the Federal Energy Regulatory Commission. So FERC is an entity that's actually under the DOE, so they're kind of together, but FERC is independent. So the DOE offers export permits, so basically permission to export the commodity at all. And there's two different ones that you require. So there's a permit to export to countries that have a free trade agreement with the US. Those are automatically approved, so that's typically not a hurdle or a problem. But non-FTA permits, the DOE needs to carry out a public interest review in order to determine that the project is in the interest of the public. And then you can get your non-FTA review. Those take much longer than your FTA. Your FTA can often be under a year, maybe just a few months. Non-FTA permits, as we'll see soon, can take dozens of months to actually clear. So that's a huge time sink for a lot of these projects. A lot of them, when they're very early on in their conception, will apply for permits like well before they have any buyers or anything like that. FERC is the other side of this, so it's not necessarily it's projects in the U.S. itself. So it's like essentially they get to decide whether you get to build the facility at all. So this is, of course, why like ICA and Saguaro do not need FERC approval, is because their projects are not in the U.S. Obviously, if they're building anything within the U.S., like Saguaro, they're trying to build a big pipeline across Mexico. Any segment in the US will be under FERC jurisdiction because it's crossing a border. But for anything interstate, whether it's electricity, nat gas, or oil, they will be the entity that's reviewing those projects. And specifically, what they do is they look at the environmental side of things. So they can conduct, like, essentially for LNG anyway, one of two types of studies. There's the environmental assessment or the environmental impact statement. The EA is just if your project, they don't really find that it's going to impact not going to have much environmental impact, they'll just give you an environmental assessment. You're pretty much good to go. The EIS is a much more detailed study where they found that your project will impact things and has a lot of stuff in it about like your remediation measures and mitigation that you need to institute during the construction of your project and during its operation. So once that's all agreed upon, you can then get authorization from FERC. But FERC approvals have over time taken quite a bit of time to get cleared, and that's gotten longer over time. So why don't we go ahead to the next slide? So taking a look at the sort of timelines for non-FTA of permits, you can see in general, the sort of expansion projects have gone pretty quickly. Cameron Train 4 was approved very fast. Corpus Christi Stage 3 was approved very fast. But for greenfield projects, it takes, 40 to 50-ish months to get a permit these days. That was complicated quite a bit by the fact that the Biden administration put about a 12-month pause on permitting, or the issuance of non-FTA permits specifically. That was basically immediately canceled by the Trump administration when he took office, so it's no longer a thing. But things had to pick back up after that. Um, and there's been quite a few approvals this year. Um, to the sort of point of the Trump administration very much trying to push as much LNG development as humanly possible. But that 12-month pause really did affect a lot of projects. The big ones it really affected were Commonwealth and Port Arthur Phase 2, which were very far along in the permitting process, and that like did delay them quite a bit, though pretty much every delayed project has gotten their permit, most notably like Lake Charles and Sabine Pass don't have their permits yet, but they're pre-FID. I believe both CP2 and CCL trains 8 and 9, at least according to the DOE, are still under review, despite the fact that they both FID'd, though I've kind of seen mixed information about that. But definitely still really important. But going forward, we at least during the next few years, we don't think permitting will be a big challenge for a lot of projects, just because of the sort of general policy bent of the current administration. Um, you can go to the next slide. So FERC approvals are usually a bit faster, so closer to sort of the 30-month timeline. But this is a far cry from how quick it used to be. I looked at a very old presentation from Cheniere, and the sort of expectation was like 12 to 22 months for like a DOE permit, and then about half of that for a FERC authorization. And to their credit, that's about how long it took the first 6 trains to get authorizations. And they had a little bit of a benefit there, considering it was already a sanctioned import project, so that probably helped. But for greenfield projects, it's been taking an increasingly long period of time. So like Calcasieu Pass took 50 months to get theirs. Port Arthur Phase 2 took quite a while. But the big thing that's different about FERC approvals is they've been challenged in court quite a bit. And specifically, Texas LNG, Rio Grande's trains 1 through 5, Commonwealth and CP2 all had their permits either remanded or vacated. So that essentially required some of them to reapply from scratch, and other ones just had to get a supplemental environmental impact statement done, so added time to the approval timeline. The reason these were remanded was basically because the courts found that the FERC inspections and conclusions didn't take into account enough of the environmental things they were supposed to take into account, specifically, I believe, Clean Air Act stuff. So they had to go back and do a new one. That being said, all of these have now been approved, so this was just kind of a delay for some of these projects. Rio Grande notably took FID with a remanded permit, so did CP2, but now they're all permitted. So really the only project that's still waiting for approval is out of the ones we're looking at anyway is Sabine Pass train 7 and 8, so the stage 5 expansion there. I've also seen kind of mixed information on Corpus Christi trains 8 and 9, the mid-scale expansion. It's FID'd, but I'm not 100%, it's not 100% clear if they have full FERC authorization yet or if it's still under review, but still interesting that they would have FID'd without it. I don't think they did, but there's some mixed information there. So you can go to the next slide. So another big trend that we've seen recently is the need to have permits extended. So a lot of the reason that this is the case is because many of these projects were, originally conceived back in the like 2010s. And like I mentioned earlier, a lot of them faced issues actually getting off-takers until the post-2022 sort of energy landscape, where a lot more LNG was needed. A lot of these projects cleared their commercial hurdles and got across the finish line and are now under construction or producing. So they applied for their original FERC or DOE permits. They were awarded them, but there's strict deadlines on both of them. So for DOE non-FTA permits, you have 7 years. That's pretty much standard across the board. There's a little bit more variability with FERC. Typically it's 5 years, but I've seen 6. I've seen a little shorter. I've seen a little longer. So not 100% sure about the clarity there, but it's mostly a 5-year deadline. So a lot of projects which are now either under construction or are trying to reach FID have gone past their original FERC deadlines. And that's what's over on the left there. The left column for each of these tables is the original deadline, with the exception of, I believe, Golden Pass, which is their newer. It's actually flipped, but that was a second. They've had 3 extensions now, or 2 extensions now to be able to, their third one is what they're asking for. So a lot of these projects have been delayed over the years commercially by construction and stuff like that. So they've all needed to get extensions. This was an open question during the Biden administration whether or not any would get them, because of the pause, and there were also some increases to sort of FERC standards that were going to need to be met. But this has all been reversed under the Trump administration. So will likely not be a problem going forward, but it definitely was a big risk for some of these projects that were, especially the under construction ones, that clearly were not going to be able to actually get a cargo out before the end of their deadlines, but were still being built. But now, not really too much of a risk anymore. So we can go ahead to the next slide. So we've talked about the sort of big trends and U.S. commercialization of LNG facilities. So what does that mean globally? What is like, so you have all this capacity coming online, and I've already talked about this already, but where's it going to go? So we're going to kind of look at that and kind of do a little bit of a thought experiment here, um, on like where we think that those cargoes might go and what the market might have to do to absorb it. So that we at Kepler, we do an 18-month forecast horizon, so out through about March or April 27 now. As I mentioned before, Europe, for the time being, is the big demand growth market. Um, Basically just to replace Russian pipeline gas supply. There's a little bit more growth possible there if Turk Stream gets turned off. If Yamal gets sanctioned, which the EU is attempting to do at the moment, that probably won't affect things too much because we assume that a lot of those volumes will just go to East Asia instead, and so there won't the market will just rebalance those volumes versus the EU, like them just disappearing altogether. Um, because the U.S. doesn't seem super keen to sanction that project. But there's also, it can be challenged in court as well, so it may not go through at all. But something to keep in mind. So there might be there's a little bit more incremental demand growth we could see there from Turkstream being cut off for sure, going into 27. But outside of that, structural like actual demand in Europe, rather than just like supply replacement, isn't really growing. Power isn't really growing. Rescom is basically flat. Industrial demand is actually going down. This is mainly replacing that pipeline gas supply to make sure that storage gets back to where they want it. To that point, you can see our forecast of European storage. So we think that like essentially the way winter's going to go this year is it's going to be a pretty cold start and then kind of edge back more into sort of a 5-year average winter, which is still colder than last year on average because it was outside of January and February where it was very cold. It wasn't super terrible in the EU, but so they'll end the season at around 39% storage full. But with the amount of new supply coming online next year, we think they will be able to get up to about 98% before winter 26-27, which is very high. So where's the additional space in that market for more demand? I would argue there's not a lot. It's basically just supply replacement still. So where else could LNG go? Everybody obviously for years has looked at China as the engine of growth in the market. Um, China really came out of the market this year for a couple of reasons. Pipeline gas imports from Russia increased with the Power of Siberia fully coming online. Incremental domestic production growth, a little bit of loss of industrial demand, and they themselves had a very mild winter last year, so their underground storage and LNG inventories were very, very high. Typically China comes out of winter with LNG inventories in like the 20 to 40% range. They were north of 70 this year, so well above that 5-year range. So we do think China is going to come back into the market. There's no more incremental pipeline supply expected next year, 27 and 26. Power Siberia 2 is a ways out. So LNG will feed that incremental demand growth. We'll still see incremental growth in production. We'll still see incremental, uh, you know, uh, some demand increases that we normally do see in China. But, is that year-over-year growth, extrapolated out to 2030 or 2027 going to be enough to absorb the amount of excess supply coming from the US specifically? And it's like the US is adding, 100-ish, a little bit more than 100 million tons of supply under construction in that time frame, and that doesn't include all the additional supply from other projects, like, big one being the North Field expansion in Qatar. And then you have some of the more traditional markets coming out of the market. You have Japan and South Korea losing demand. Taiwan's growing a little bit, but not that much. South Asia and Southeast Asia are more interesting here because while there is some structural demand increases there for sure, a lot of what we think was driving their 2026 demand will is actually lower prices. There's a lot of price sensitive buyers in places like India. There's a lot of price sensitive buyers in places in China as well. A lot of second tier Chinese buyers will buy LNG when it's below certain price thresholds. A lot of industrial and power customers, but especially industrial customers in India, will buy LNG once it becomes a bit cheaper than fuel oil to burn in their boilers. So there's some price sensitivity in there that will come into I think the four, once more supply comes online, causes prices to drop. And to that point, you can go to the next slide. So prices we expect to drop to stimulate demand, to absorb all this supply. But a big question I've been asked many times, especially when we were at Gas Tech this year, is are US projects going to have to shut in? Everyone is seemingly expecting there to be a pretty big oversupply in the late 2020s. Where's that demand going to be to absorb it? It's, like I said, there's the hopes that you've got your structural demand increases in those big markets like China, and then also your second tier buyers who are more price sensitive coming into the market as prices dip below the sort of $10 range. But is there a risk of, US projects being shut in like we saw in 2020? It's a good question. Obviously, a lot can change depending on how the winters go. That leaves up a lot of potential demand up in the air. If we have a bad winter in both Asia and Northwest Europe, then that's a lot more injection requirements this summer and maybe helps with that. So there's definitely a lot of uncertainty here. And it's not a question I have an answer specifically for. I wish I did. I wish I had that crystal ball. But sadly, we don't. But sort of what would it take, though, for US projects to shut in? Well, during 2020, which is, of course, an extraordinary event that's very, not going to happen all the time, we saw US projects shut in earnest basically when US like Henry Hub times 115% was greater than the delivered prices of LNG in both Europe and Asia. So it just became more economical to reject the gas back into the US gas network. That's probably what it will take. There's still some money to be made. Even when the prices get closer together. But until it's like, okay, I might as well just sell this gas into the US, that's probably going to be the condition that is required. And like, but before that, you may see some reductions in the cofaction output, especially from projects that, like, Cheniere's projects that they sell a lot of their own volumes. Maybe you'll see sort of an advanced reduction there in output, just delivering to their customers, not wanting to be exposed to, sort of a broader bear market. And then on that graph on the right, we show Henry Hub times 115%, and then with an added shipping cost. And the shipping cost is based on a sort of freight rate of about 160K, so much, much higher than right now, but a more normalized sort of market rate where the excess ships that are on the water right now are being utilized by their projects. So you can see, even these are the forward curves, by the way, not our forecasts. Even the forward curve is, showing pretty low TTF and JKM prices, there's still a solid margin there that I think would leave US projects still wanting to operate. But then again, so much is dependent on what the winters end up being like, what the summers end up being like, geopolitics and all that kind of stuff. So more of just a thought experiment than anything else, but it's definitely something to keep in mind. And I think there's quite a bit of risk involved with all the supply coming into the market. But yeah, so that's what we have today. So we'll leave it open for some questions from the audience. And thanks so much for joining us today.
Thank you so much, JP. I know you spent a lot of time kind of going through the contracts database and FERC dockets, probably quite a few days of research there. So thank you so much for all of that. And it's good to look at different things other than the outlooks as well. So appreciate that. We will have questions coming through on where you can get the slides and the recording. As always, they'll be put onto the Kepler Insight website under the webinars page. So please do feel free to look at that again. A couple of questions coming through as we went through the presentation today. And this one, I might actually go back to one of the previous slides because someone's asking about which projects we think could FID next. Of course, if we look back to your slide, JP, a lot of them had off-takers already, nearly kind of 90% of the offtake supply had been sold. So, are there any of these that you think could FID sooner than others?
Yeah, it's a great question, and I think a lot of people are wondering that same exact thing, who to put the money on. I think, from my opinion, you're the most likely projects to go for. I mean, Commonwealth has been moving quite a bit lately. I mean, it's still got quite a few unsold volumes, so we'll have to see, but it does seem like they're getting some momentum. Rio Grande Train 5, I think, is very likely to go forward since Train 4 just FID'd and they have a good amount sold. Um, you have projects like Lake Charles and Saguaro, which have had most of their capacity sold for quite some time now. I've been trying to reach FID for years, especially Saguaro. They're a little shakier, but I think, the expansion projects like Sabine Pass and Rio Grande are very likely to be soon, especially Rio Grande, just because it's more of a sure thing once the infrastructure is already in place. So my money is on, Rio Grande Train 5 probably being the next project to hit FID.
Hmm. Okay, interesting. Thank you that. And also a question on the outlook for Henry Hub prices as well. Of course, this is a lot of LNG supply coming to the market, and we need to source the gas for these projects. So, what do you think is going to happen with Henry Hub prices as we go through the rest of this decade?
Yeah, it's a really good question. I mean, there's definitely a lot of hype around feed gas demand. There's also a lot of hype around like data center and AI demand. I think the feed gas demand is well founded. These projects are being constructed. They need an amount of gas because that's what they sell. But the AI stuff, I think, I mean, some of it is very real for sure in terms of electricity demand, but I don't think it's going to be quite as big as some people assume. So personally, I think Henry Hub is probably not likely to increase substantially in the latter parts of the decade. I think suppliers are becoming much more flexible and sort of moving with the market. As we've seen the last couple summers, they've been, especially this summer, they've taken supply offline, brought supply online when the sort of market conditions accommodate for it. Especially like we're in the Northeast, where if local prices, like we're seeing literally right now, are low, they'll shut in production just a little bit. If it's higher, they'll increase it. So I think producers will largely be able to keep up with what's going on there. So I think that will keep the market pretty well supplied and will keep, Henry Hub prices from, blowing up above like $4 on average for a whole year at this point. I think there's plenty of supply available.
Great, thank you, JP. Unfortunately, we're out of time for today. Thank you, JP, for all of your analysis, and yeah, hope everyone found it really useful. Definitely watch out on the Kepler Insight platform for those slides and the recording to go up later today. So thank you all very much and have a great day.